Magnificent Seven has had an incredible run, but it does look like the rally is beginning to broaden out. And I'm interested to get your view on that and its impact on your portfolio. I'm going to start with Sven.
Yeah, last year it all has been around the Magnificent Seven. I mean, you had an average return of around 80%. If I round up a little bit, the rest of the market, as just mentioned, up percent, only 8% up. But that's changing already. Look at the beginning of the year in the large cap space, you have financials, industrials, healthcare, materials, all these companies are coming back. And the same is true actually in the small cap space. All the small cap indices, value, core growth are in positive territory, double digits since the beginning of the year, especially strong in the quarter to date period. And I think this is only continuing. The expectation for small cap earnings is twice as strong in our view than for large cap earnings going into next year already. So we see investors moving away from this concentration in the market. Those top 10 stocks in the S&P make up 35% of the index. That's a lot of concentration in two handful of names. So investors are moving down, investors looking for more opportunities in the small cap space, and they are also in the small cap space broadening out. So the sectors that I mentioned, industrials, materials, we also like them, especially when we look at the small cap market. So I do think this broadening out is continuing, and especially when we think about AI, this is only going into impact all of the other sectors that have not benefited from this trend that much yet.
Excellent. Well, this broadening out is really definitely going to affect those small cap sectors that you've just been talking about. And Dean, let's talk about the broadening out, because again, that, for your sort of equity income type companies that you're investing in, that might be very helpful too.
There's no doubt this broadening is underway, and it started in and around June, July of this year, and it's continued since. And again, assuming central bankers continue to reduce rates over the next 6 to 9 months, I think that becomes a catalyst for further broadening. And when you think about the sectors that we think are best positioned to benefit from that, we think the REITs, which is an overweight position in our portfolio, and particularly we're focused on Canadian REITs, putting office aside, they're basically dealing with a lack of supply because of higher construction costs and more recently higher interest costs and continued growth in demand. And that's a very, very positive combination of factors for rents continuing to grow. And the REIT sector, for example, in our portfolio is up by about 15% since mid to late June this year. So the re-rating is occurring, and they're still trading at a significant discount to what we think these businesses are worth. The other part that I think is benefiting from this broadening is the energy and energy infrastructure area. On energy infrastructure, we've got pipeline businesses that are very predictable in terms of their revenue streams and cash flows. And again, they're viewed as being income proxies and interest rate proxies. So as a result, they're benefiting from this reduction in rates. And then you've got growth in production, and some of our energy producers now, whether it's oil or natural gas, we think are benefiting from the fact that the world is coming to realize it can't just rely on wind and solar over time. That will become an increasing share of that energy pie, but you need baseload power. And that's from natural gas in particular, especially as we continue to build out these data centers. So we think those areas are doing very well and still have significant runway.
Absolutely, that broadening out really beneficial to those, and obviously things like REITs very interest rate sensitive. Now, Gary, obviously you have benefited from the Magnificent Seven's great success, but I'd be interested to get your view on the future of those, and also whether this broadening out is going to impact on your portfolio.
Yeah, I actually don't find these broad brush terms like Magnificent Seven that helpful when thinking about where things are likely to go, because what you have underneath that classification is a lot of quite different companies, and we're still very positive on some, and we're less positive on others. And so, two that I would highlight that we're very enthusiastic about at this juncture are Amazon and Meta, but we haven't historically owned the likes of Apple and Microsoft in the portfolio. We feel that the valuations of those two companies look quite full relative to the scale of the companies and the future opportunities. Whereas for Amazon and Meta, we think there's a lot more growth runway there and a more reasonable starting point with regards to valuations. I would agree with the broader point that that we own a number of mid cap growth stocks in the portfolio where it seems like fundamentally we've been tracking ahead of it for quite a long time. And we saw that last year with the our investment trust, where we had, I think it was 38% weighted average revenue growth in the portfolio in the year where the NAV rose in the mid-teens. And so the companies are executing well. A lot of these mid-cap companies haven't been rewarded by the market. I think part of that was the expectations around interest rate cuts being pushed out. But our sense is there's quite a lot of potential energy in these companies now, with valuations having come down, but fundamentals remaining strong.